Welcome to the week starting 24th of July 2017 for the macro thematics. Realistically, there's only one thing to concentrate on from an Australian-centric point of view, and that's on Tuesday, and that is around our CPI read. Core inflation and trim mean inflation really need to be what you need to look at in terms of how you actually probably position yourself, not just for this week, but for probably the rest of 2017. Last week, as we know, there was so much talk around inflation here in Australia, in Europe, and in the US, and what that means there for monetary policy. Clearly, from an Australian-centric point of view, monetary policy is being bullish, and I'm not using the word hawkish deliberately because they are more optimistic, but they're certainly not suggesting that they're going to move rates sometime this year. But if inflation on Tuesday does move up, then it certainly brings that idea, and it could be a real positive for the Aussie dollar. It could push it through 80 cents and even as high as 81 cents if it's there. But looking at those figures and looking at the numbers, trim mean expectations and the consensus read currently is for trim mean to come in for Q2 at around about 1.7%. That's below their mandate of 2 to 3%. It is also the headline figure might be quite eye-catching. It could be well into the twos, and the reason for it is that Cyclone Debbie is no longer in the figures, and there is a real growing expectation that particularly fruit and veggie will actually really explode. It's the same also with petrol. Petrol went the other way, and it may be a drag. So be aware that headline figure could be quite volatile, but look through that. Look at the trim mean figure. So what does that therefore mean longer term? If trim mean is actually expanding at a reasonable rate, the forward idea on it could be that we see trim mean inflation hitting 2 to 3%, end of December for Q4, more likely getting that in February. And that therefore needs to be the base case model if you are seeing inflation coming, and it gets back to the RBA talking around the idea of normalising rates. We do know that at the moment the RBA is a bit more hawkish, and you've seen since Philip Lowe's taken over from Glenn Stevens that he is a little bit more on that side. So he is moving to the idea that they need to probably get away from this super accommodative stance of 1.5% on the cash rate. But again, it's a long way off, and I think that needs to be where you think about it. What does that therefore mean for your portfolio? Again, discretionary is the part to really give you a good gauge, and the reason for that is that if there is any signs that rates would move to the upside, discretionary is the first part of any household budget that actually gets clamped down on. So that's one part to look at. Second part is also the banks, and the reason for that is that if you were to see increases in the cash rate, it would therefore mean mortgage rates go up, and therefore does the banks pass it through in full? Does that also put pressure on people's budgets and on therefore cash earnings for the banks? All that's also something to be probably a mandate and also a bit of a benchmark with regards to how you look at it. So next week, although there is other data, I really believe that Tuesday is your main day, and certainly something we'll discuss more over the week in the head.
Intelligent Investor Equity Income. Actively managed by the Intelligent Investor Analyst team, the Intelligent Investor Equity Income portfolio focuses on undervalued businesses that have the ability to pay a steady stream of growing dividends. Through investing in a concentrated portfolio of undervalued businesses, it is the income portfolio that doesn't leave growth behind.